when you see a swing high to a swing low, or in other words, a price range in the markets, you want to be looking out for this specific confluence right here, which is called equilibrium. Okay, so in this scenario, we have a swing high to a swing low. This is a bearish example. And then in this one, we have a bullish example where because it is a swing low to a swing high. And essentially, the equilibrium tool is going to look exactly like this. So for the first example where we have in a bearish example, we take the top, right? We mark out the top of the swing high to the bottom of the swing low, the bottom wick and the top wick, right? And then we plot the 50% line between these 2 points, right? Between this price range. This point right here is a point in price where the buyers and sellers have agreed to a specific price, and it's where the price moves sideways and no new highs or lows are being created, but it is an equilibrium and a good balance of where you want to be entering, and it also determines whether you're entering in the discount or premium. So this is going to be it for a bullish example. Same exact thing here, swing low to swing high. And essentially, as you guys see, equilibrium 50% mark. In a bullish example, the discount equilibrium, or in other words, the area where we want to be entering as retail traders, is going to be this area highlighted in orange. It is because when you don't want to same reason you don't want to long, when we're all the way up. You don't want to short when we're all the way down. Why? Think about it logically. Because when you do so, the market is less likely to continue going in that direction, right? So like, I'm not saying because think about it. If the market has already moved up so much, right? And then you try to long, what are the odds that it just goes ahead and stop you out, right? Because you guys have to think about it like this. When the market is moving up, all the retail traders, all the people who the banks are trying to get their liquidity from are longing. They're clicking long because they see it go up. What's the simplest solution? To click long. Or they see it go down. What's the simplest solution? To click short and bet it's going to go lower, right? Trading with the trend is a good thing, but you want to trade with the trend using these confluences, and specifically this time equilibrium, because when a price has already gone so high up and you're trying to keep longing, do you know everything price is going to retrace? That's why you wait for a small retrace. It doesn't have to be all the way down here. You don't have to enter all the way down here, but you wait for a small retrace into a key area where price would most likely reverse off of, which is going to be equilibrium here. And you essentially use it the same way you use all the other confluences, where you wait for price to enter this area and then catch reversals and entries off of this somewhere here. Okay, this could be a higher time frame example, and then on the lower time frames you could catch an entry right here. So the example for bearish right here is going to be the exact same thing, right? And in this case scenario, when you want to wait for price to enter this zone, this discount zone, and then you want to short. Now, what is this? You might be asking. This is the premium. I do take trades sometimes in premium, and it's not always a bad thing, but most trades you want to be taking in discount of price of it might be a higher time frame, swing low to swing high, or swing high to swing low, because it is the more probable area of price to reverse off of. And this is a good point here where entering this trade will not be a bad idea, because you're not just thinking as simple as the retail trader. And for example, if a retail trader enters short down here and they put their stops here, then they get stopped out, but it now gives you a better entry to then take shorts going lower. I don't know why this is down here. It should have been up there, but whatever. You guys get the point, right? So same exact thing for for long scenario. We have discount up here, premium down here. So let me go into TradingView right now and show you guys right here. So we are now in this here, and I'm going to show you guys how we can use this specifically in the markets every single day, just normally, and how I personally use it, okay? And then I'll go over the example of what happened today, actually, and because I think it did play a role. So let's go ahead right here. So we have this. So again, I'm just trying to find moves here, right? We're on the 1 hour time frame, okay? So what do we get? And remember, this strategy, this confluence works with all the time frames, every single time frame that you guys see here, and even more, all of them, because price moves the same in all of them. So right here, what do we see? We'll take this high to this low, right? We'll plot it out. And equilibrium did not get hit. We'll take this high to this low. And as you guys can see, from this low to this high, this area right here of price is the discounted area. And so we want to take entries here or somewhere here close to this area, so that then we have a bigger chance for, you know, a better RR, a better risk reward, and a better trade idea and a more valid trade idea to then price to then go higher, right? So this is a bullish example right here. From there, I can show you guys, let's see, this right here. We have a swing high, swing low. What does price do? Remember, it doesn't have to fill it exactly, it never will, but for the most part, it comes down into this range right here, okay? We come down into this, and then we see short opportunities. Whoa, that's big. We see short opportunities off this, you know? Again, although it does stop you out up here, we're not, remember, this is the 1 hour time frame. This is a very, very, very high time frame. You know what, in fact, let me go on the 15-minute and show you guys this, because I think the 15-minute would be a much better time frame for this. Yeah, it would be for example, right here, okay? We take this to this, price fills it, and then in turn goes higher, okay? We take this to this, price fills it. Oh, and by the way, for it to fill it, it can enter all the way through here. We just don't want it to close through. We want it to fill somewhere around the 50% mark. We want the candlestick to go and wick inside of it, or even it could even close inside of it. That's fine, but it needs to be somewhere near this line here, the 50% mark, near it, and then we want to wait for a closure out of it. So if price, for example, just ran straight through it and just closed here, closed above this, our initial high, obviously we're not going to count that, right? So it can still close inside of it, it can still do that stuff, but this is how I use it in the markets, right? I'll show you guys another example right here. Oh, right here, bang, bang, price fills this area right here, then in turn ends up going higher. Now, this is another example right here where a lot of you guys, you know, you might not think this is very clear and obvious, but it really is, because look, again, we go in, we fill it, remember we fill it here, and it doesn't end up going lower. You see that? It doesn't. Remember, this is an example of where it doesn't work, where we fill it, you think it's going to go lower, but why doesn't it work? Because price never closed down here, right? And so there you go. And so in turn, price might have faked out some people and then can continue going higher. But remember, all of these confluences are not to just be used by themselves. You need to use them with external liquidity and all that stuff, all the other stuff, in order to form like a bias, and then in order for it to be more effective, right? So so that is how to do it. So, and also not all of them are going to work, all right? And then let's go right here, bang, bang. We don't fill it, we get close though. Let's go on NASDAQ real quick. See, look, on NASDAQ, this example, it filled it. You see that? So on NASDAQ, this exact example, we fill it exactly. We wick it and then we close above, and in turn, price ends up going higher. Right here, another nice example. Swing high, swing low. Nope, that doesn't do it well. Yeah, right here. Swing high, swing low, we close somewhere inside of it, and then boom, push lower. Here, swing high, swing low, we close inside of it, and then we end up, pushing higher, faking people out, and then we just go much lower, right? But I'm just showing you examples, but don't just go in the market and look at it and just to use it like that, because, you know, that's not how it works, especially equilibrium. Like, equilibrium is a less used one than something like a fair value gap or something like an order block, you know? Right here, we have this high, this low. See, it doesn't even fill it. It does not even fill it, bro. Let's go in. We have this. No, it doesn't even work. I'm trying to spot it. I'm trying to spot it as well, guys. I'm really trying to spot it as well. It's confusing me. high, low, fill this. This is our fill. In turn, ends up price leads price into going lower. So now let me show you guys the example that happened today, from what I believe. So I'm gonna open this. This is my like indicator, whatever. It shows the stuff here. And okay, so right here, for example, this is market open, right? As you guys can see, why did price come lower? It came lower to sweep out this liquidity point right here, fill this gap, but also what happened? Tapped equilibrium, exact tap of equilibrium, okay? Exact tap of equilibrium. Remember what I said, roughly in the equilibrium range. We got an exact tap here, and then price went higher. So if you tried longing up here, right, why is this not smart? Because we're now in a premium of a bullish leg. And remember, in order for price to go higher, it needs to go lower, right? Because, that's how the markets move. So you don't just want to keep longing whenever it's going higher. You want to wait for the retraces. In this case, a tap into equilibrium, which also would be a higher, stronger confluence because of, we had this fair value gap and, we also had this fair value gap on it. So you see that, and then in turn, it pushes price higher. So this is exactly how you can use equilibrium. It's a very simple confluence. Just like pretty much all of these confluences, they're really, really, really simple. And yeah, that is exactly how you use it. Thank you for watching this video. If you have any other like advice, tips on like, or not, what am I saying? If you have any questions for like other confluences, make sure to go ahead and tell me. And yeah, thank you guys for watching. See you in the next one.